You're listening to the Accenture Insurance Influencers Podcast.
Welcome to the latest episode of the Accenture Insurance Influencers Podcast. I'm your host, Igrani Yu. Today, I'm speaking with Eric Joost. Eric is the global head of property and casualty at Willis Towers Watson, the third largest insurance broker in the world. Hello, Eric. Thanks for making the time to speak with me.
Thanks for offering the time to me, Agrani. I'm looking forward to it.
Absolutely. Now, I have lots of questions, but I wanted to start with a bit of background. Tell me a little bit about your role at Willis Towers Watson and your areas of focus there.
Sure, happy to. We do three things just at Willis Towers Watson, which is simply in the category of people, risk, and capital. We're a merged business, and that actually will speak to some of the things I'll talk about. We're 3 years away from a merger. I generally focus my time in the risk part of our business, not exclusively, and I'm part of our global leadership team. For me, I do a lot of work around strategy and connectivity. So how do we follow global trends where clients want service and action globally? In addition, I do a lot of work around client experience. So what's our delivery like? Consistency when it's relevant? What are our skills? How do those skills need to change? Are we providing enough context for clients in a complicated world? Connected to that, I look after all our technology. That's everything from rationalizing some of the historical things in the tech stack to investing and innovating around new areas where we've been pretty active. And then finally, I spend a lot of time looking for opportunities between our bigger business units in the firm. When do we have companies that actually want to combine a conversation about risk with a conversation about people? It's not for everybody, but when it's there, we spend a lot of time doing it.
Fascinating, and certainly a lot of opportunities for cross-pollination as this world kind of becomes a little bit more blended. I imagine that there would be more opportunities for those types of conversations.
Yeah, I think we're all seeing those types of things, and it's not a struggle. It's just, remembering to meet the clients where they are. Certain clients we have want that conversation and realize that there's nothing in the risk world that isn't either firstly or greatly impacted by how people behave, and that's an oversimplification. So if you really want to deal with risk, you got to deal with people. So that I think everyone makes that connection. Is their business and the way they want to run the business in a place where they want to act in that fashion today? Not always, but the ones that are, we're ready for, and the ones that aren't, we're sort of prepping the environment so that as we get more use cases, we can sort of make that clearer to people, if that makes any sense.
Mm-hmm, absolutely. And I imagine that personally, you've seen quite a lot of changes in the insurance industry. I understand that you've been at Aon, Allianz, and previously at Willis prior to the merger. And obviously, our world has changed tremendously over that period of time. I'm curious, what are some of the biggest changes you've seen in the insurance industry over that time?
That's a good question, and it's sort of I'm sort of smiling a little bit. Because when I was younger, I used to ask that question a lot, particularly when I saw people that mentored me retire. What were the biggest changes you've seen? And so now I'm feeling a little aged at this point based on the fact that you asked the question the way you did, which is completely fine. I mean, I think of it in four categories: speed, data and analytics, just the size of the market, and broker consolidation. And I'll just expound a little bit. From a speed, technology really influences the first two things. I mean, speed, when I came into the business, it was letters, it was faxes, now it's internet, now it's email. There's a lot of good things that's brought, but by the same token, what I have noticed that I don't really enjoy is, when you were using a letter, the writing and the thoughtfulness that went into that letter was very deep. And to some degree, as the speed is turned on in the industry, there's been a decrease in thoughtfulness to some degree and a decrease in context, if that makes any sense. Information's moving, but no one's kind of putting it together for people as well as they used to. And so a change that's very helpful for efficiency and moving information and making decisions is terrific. I'm not sure that we're always good as an industry at helping our clients see through that complexity And I'll say something like this, as the amount of content and information increases, the risk we face is the context goes away. And I think some of that's happening. We're working really hard, and we won't be perfect, but to try and get even from a millennial point of view, get people to slow down and to really challenge each other with, what is the message and the narrative you're delivering, not the how fast can you respond. On the positive side, technology has really helped on the data and analytics, and not that we didn't have data and analytics, but the speed, the available data sets, the access to information more quickly has been terrific. You're now able to bring almost any situation, to almost any risk situation, better quantitative outputs to measure the risk, to measure the choices than we've ever been able to do before. That doesn't mean that the world is, the insurance world is being run by machines or everything is quantitative. All this quantitative output and insight is getting complemented by experience, constraints companies have, what peers do, but it's very complementary. And from 30 years ago, the math, the quantitative sort of input really wasn't there. And there was just too much weight on experience and war stories, if I want to be negative about it, and things like that. So I think that's really helpful. I also think that the data and analytics that we're building today and getting better and better around how we organize data will drive innovation in the next 10 years. It's a critical component to get other participants in the market. So I'm very optimistic. And, the last two things I mentioned, just the scale of what is insured these days. We want to insure more. We can look at post disasters and go, there should have been more insurance purchased. But if it's just the scale of how the market's grown along with the world economy is amazing to me, when I just was kind of looking at old numbers and new numbers. And then the last thing, which probably has some good and bad in it now, is, I work for a very large broker. We've been a consolidator. Aon, where I worked before, was a consolidator of brokers. There's a lot of things that have come out of the large amount of broker consolidation that's gone on over the last really 20 years. And the consolidation that continues, you have what was the top 20 brokers is really concentrated almost in the top 3 or 4 now. There's many great things about the scale we're able to bring. That brings many more specialists to bear than we could ever have possibly afford in the past. That brings technology leverage across the whole business. And then on the bad side, I don't necessarily think consolidation is bad, but it creates perceptions around lack of choice or market power that can be challenging for us to sort of not defend, but to just talk about and articulate around. My sense is, if I talk to clients, and I do quite often, they're not short on choice. There's plenty of choice, there's plenty of competition, but I can see where this concentration of power can be positioned differently in people's mind, and that's not always a great thing.
Certainly. And those 4 changes really have transformed the industry. And particular to insurance brokers, the actual people who are working in that field, I mean, there's this old school picture of insurance is bought and sold at the kitchen table. And to some extent, that's probably still happening. But, in what ways has the role of the brokers themselves changed over that time?
Yeah, I mean, that's the stereotype. You described it, and to some degree, I'd agree. It still is out there, and I think in some cases that's a good thing. But the way I'd look at it from where I sit is, when I first came in the industry, there was a lot of pressure around what today are more basic things, which is, clients needed insurance to protect them. It was even the very large customers, the balance sheets weren't so fortress-like as they are today. So actually just placing insurance and the process you went through, not just was insurance available in some cases, in other cases, how much insurance can I buy? Because the market wasn't fully developed. And obviously there's always how much does it cost? And so there was a lot of effort around the placement and getting people to understand the process they're going through, physically bringing people around the world to different insurers to reinforce, I'm serious about this. I can tell you a more nuanced story about why I manage risk better, and so forth and so on. Now, if I transition to today, it's not that that work doesn't exist. It does. All those things still do matter, but to some degree or another, we've brought as an industry a lot of efficiency to that. I mean, I can literally have a broker in the middle of the United States today into the global market with, whether it's through email or through one of our broking platforms, within a matter of minutes from the time they start to think about, okay, here's a way to describe what the client's doing. Here's what I'm looking for. That isn't relevant for every single one of our customers, but that's an amazing shift from when I wanted to do that 30 years ago. That was a 4 or 5 day piece of work. I was assembling giant binders of information that wasn't necessarily structured technologically, and I was shipping it in FedEx and UPS boxes all over the world, and then following up with faxes and phone calls. Now, so we've made that part of it very efficient. It's still very valuable, price transparency, price arbitrage, things like that. What we're doing more of is that, we talk about the advisory side of our business, and too often when we talk about it, we tend to say, well, the world's moving to advisory, and therefore the broking or placement part of the business is going away, and it's not. What we're doing is more. We're still doing all that transactional work, and then we're doing things now, and this would be a subset, but things around straight up risk management for our clients, helping them get inside the problem and think about the risk or the problem they're trying to solve.
You're listening to the Accenture Insurance Influencers Podcast with your host, Igrana Yu. If you like what you're hearing and would like to hear more podcasts from Accenture, try Talking Agility, a podcast that takes an in-depth look at enterprise agility. Leading experts cover what it is, why it matters, and most of all, how to achieve it. Visit accenture.com/talkingagility. Now, back to the Insurance Influencers Podcast.
Can you share an example of this approach to risk management, either from your insurance practice or from other parts of Willis Towers Watson?
Things like project administration in the construction space, very, very large, massive projects. We take on a lot of the logistics around the project administration, all the subcontractors, and then all the other kind of components of insurance and related issues. You would see us 20 or 30 years ago, we were just talking about getting project insurance placed by way of example. Today, we're talking about how do we bend that cost curve and that risk curve from what used to be maybe 7, 8, 9% of project costs. And now we're talking about numbers 2, 3%. And then here are the mechanics you can go through to actually drive that further down. And then we do tons of contract review, which it's, not insurance contract review. It's like you're signing a big consulting arrangement with, let's say, obviously a client. What are the process implications around how you've brought that contract together? How does that knit together with, say, your professional liability insurance? And in some cases, firms that of a certain scale, those are enormous decisions they're making, when they're doing, say, several $100 million projects. What I would say, and you're seeing this in the construction space, and it surprised me as I've walked into it in the last couple of years. We're actually talking to the whole ecosystem of large infrastructure projects. And that's everything from financing to the sponsor to all the different lawyers and consultants, and just say, listen, the way we're building infrastructure in the world is a little bit broken right now. And the problem with that is it's keeping money from getting to necessary infrastructure. The investment return's not there. There's too much risk and the margins are way too thin. And part of what we're through consensus with all these participants, we're at the table talking about how do we orchestrate this process or running of the project better so that we can de-risk these projects, we can make them returns more reliable, and as a result, we bring more capital into the construction business. And again, I couldn't have imagined talking about that 30 years ago when I broke into sort of insurance and trying to place directors and officers liability for savings and loans in the United States.
That's quite the story arc. And what I'm gathering from our conversation so far, Eric, is that whereas maybe before the insurance world and brokers were much more focused on the products and on the transactions, things have become more holistic. So it's almost like using risk as a lens to look at a business and provide not just advisory in terms of what insurance products do you need, but how can I, as an advisor, better help you use that risk in other parts of your business.
That's a very good way of expressing it. There are things, and some of this advisory work wasn't I wouldn't describe it as like we just, a light switch changed and we decided, okay, now we need to be advisors. What happened, and there's different nuance of this in all of our businesses, but in order to be competitive, as we were seeking the transaction business, we kind of subtly became advisors because we started to realize that was a very important part of the conversation for someone to trust you with, the transaction work. And that, the early stages of quantitative work came in because competitively, in order to sort of take maybe a complex situation to market or a mid-sized situation to market, you needed more tools to explain to a client why they were risky or why they weren't risky. We have a business around, we call it security business. It deals with kidnap ransom in parts of the world. And as much as we sell insurance and services in the event somebody might be sort of, abducted, someone said in a sort of wry sort of way, we realized, our clients would much rather never get abducted than have to worry about the insurance. And I mean, and we, that kind of stuff is coming into the business. It's always been around the business, but making it approachable for clients is sometimes more difficult, and we're just getting better and better at it. But it's important because, at the end of the day, I mean, you either more than likely you live in an apartment or a house. I have a house back in the U.S. And, at the end of the day, you just don't want the problem of, say, a fire in your house. And not because the insurance won't respond, but because everything else around it is really, really kind of, a pain. You just have to go through this massive sort of project on your own. So avoiding problems and making people feel like you're doing that in a way that's valuable to them, I think is critical. And then, I think the world will be able to, through data, there are examples now where more sophisticated data and analytics will allow us to maybe take two types of risk and correlate them against each other, maybe more like the financial markets do today. And maybe allow certain clients who want to get in that kind of equation, an ability to offset risk, wash it against one or another, and then maybe further optimize a portfolio. But, that's a 10 or 15-year trajectory that, I may or may not be on this podcast by that time, but I'd like to see it happen.
We'll have you back in the 10 or 15 years, Eric. We can
Thank you.
wax reminiscent about this one. So I'd love to take a look at, we've sort of hinted at this idea of disruption. That word is horribly overused, but for lack of a better term, the disruption that's taking place in the insurance industry today. I'm wondering what that means for brokers in particular. And you've mentioned speed and this need to respond quickly, but maybe at the cost of context or a narrative arc. You've talked about access to data and analytics, which can enable an innovation, but could also be really overwhelming if you're not prepared to deal with it. What are some of these current challenges and opportunities within the broker side of things?
Yeah, I think you describe it pretty well. From my point of view, you describe it well. It's a great opportunity for us. In more cases, it is just like the example I gave you earlier about the last 30 years. Where what we were doing in placement and broking, as we've moved to perhaps more of an advisory role, that other work never went away. I see a lot of similarities, in disruption for us, meaning for the most part, this actually creates new markets and new places for us to express ourselves, work for clients, bring value, but it doesn't necessarily eliminate the sort of what's going on today. And the thing, as I look at disruption, and it's always interesting to talk about a simpler message. And if you talk about insurance, say like you talk about banking, it's a very easy mistake. And the mistake is not that we're both in financial services and disruption will both affect us. And it's probably these, I would say, banking sort of going through that process first before insurance. But insurance, even in the corporate and mid-corporate space where we're in, for the most part, it actually operates in hundreds, if not thousands, of segments. And a lot of where the disruption occurs is at those permutations of hundreds and thousands, not at the industry level. And it happens first and foremost, nothing's going to be disrupted unless a client thinks it's a good idea. It happens first in the client sets. It's industry. By what I mean by that is disruption. The construction industry and insurance will disrupt at a different pace than the banking industry of insurance will disrupt, or the technology. And then thirdly, geography matters in our space. And it's not just because it's a property insurance and a property is a physical location. That does matter. It does change by geography. But you operate in different regulatory environments and countries and things like that. So the way we look at it is, really trying to break these things down to the a relevant enough segment that disruption can occur, and then make that work at that level.
It sounds like you're describing disruption not as this nebulous market force, but as something that happens at the intersection of business segments. Can you share an example of what this looks like in practice?
If you think about automobile insurance, you could say North America, you'd see in the US, it's a very digital business today. The US statistic is something like almost 80% of the stuff is done through the internet now. Now, what you might miss in those statistics is the time for auto insurance to change in the US with largely the same mechanics and to some degree an ability to be digital has taken almost 10 to 15 years. Okay, so that's the deepest penetrating, fastest moving piece of disruption in the US. And there's lots of interesting tangents to this with automated, kind of the sharing economy, automation, automated driving and stuff like that. But if you just move from the automobile space in a consumer environment, you go to the SME space, what you're going to see there is clients, they're usually entrepreneurs. They're not doing work between 9 and 5. They want simple, fast sort of access to, hey, I need insurance. Here's my information. Can I get an answer like immediately, which is true. But they also want, some people have said, I'll make that completely digital and I'll just, I'll destroy the insurance agent. Most people, because I've seen people walk back from that, is, they want a semi-digital experience. The clients do. So as much as I want a simple offer and to know what my options are, I'm fundamentally dealing with kind of a complicated product, and I want somebody at that last moment to walk me through a little context. But what is happening in that space is a lot of the stuff is going digital, and then that forces some reset in the how you invest in technology if you're focused on an SME segment versus maybe the large and complex segment where we play. But it does allow you to start observing how your clients work digitally or how they interact with you, meaning there's lots of amazing things that Google can see and Facebook can see and Amazon can see about customer behavior. And if you get out of some of the darker rhetoric that pops up in that data, there's wonderful ways to improve the client experience. And so you're seeing some of those groups getting pretty good at that. And if you flip over to where we're at, we're in the highly custom space. That doesn't mean it's not being disrupted. It's just some of this new technology is allowing us to sort of increase our ability to serve digitally and sort of through people simultaneously. We're able to get better and deeper on, if you think of a Fortune 50 company and they want to think about risk and really kind of think about how they infect that, we're able to get into that in a much different way than we were 10 years ago. We can see price arbitrage, between the identical product in two different markets very quickly now, where before that was more of a rumor to exist, and that's great. We can take advantage of that for our clients. We can bring transparency to our clients that was difficult 10 years ago. That's terrific. And then, by the way, a lot of the disruption is helping the administrative side of our business get more efficient, whether it's by, being more technological, using less people, or just being more effective, less error prone, things like that. But again, we use that construct to talk about insurtech and technology and how all this is affecting us, because until you're at that kind of segment intersection, you're probably talking about the issue in way too a macro context that doesn't apply very easily to any corner of the industry, if that makes any sense.
It does. And we've mentioned challenges and opportunities, and they tend to be kind of, two sides of the same coin. With the number of changes that are happening right now, the speed of changes, and you've mentioned regulatory environments and geography, I'm wondering, and obviously this will depend on which segments we're talking about, but from a broker standpoint, to keep up with the changing regulatory environment, both that regulates their work as well as policies coming down from the individual insurers as they try to respond to those shifts in the marketplace. Can you comment on that, maybe splitting that between sort of the consumer and SME level versus the corporate level where Willis Towers Watson is operating?
I mean, first, it's a good thing, and we operate in hundreds of countries, and we have to honor that very sincerely. I think, it is from, if I just take the sort of window of, the last 20 or 30 years, it's certainly a more expensive environment to operate in, just to have that appropriately controlled and understood. It also, it creates a bit of confusion, because you can imagine you've got a lot of, different regulators, different locations, people, human beings with different points of view. What I do see, though, which is good, is, I think, on the consumer side, I see a more and more of an opening of the regulators to an environment of protection for the consumer, but simplicity in the transaction. Not everyone's getting it right, but it's the direction of travel is correct. And I think that, if you want to have a highly efficient market, at some point, it can't just be, hey, here is a technological comparison machine, and it just spits out a few things that, will let you make a decision. You need a better sense of what you're buying and what it does and how you need to interact with that product if something goes bad, things like that. So we'll never get it perfect, but it's going in a nice place. And so I think that's great. On the complex side of things, on the one hand, we get a lot of scrutiny. There was a FCA in the UK just released a report on, the broker market and the London market, wholesale market here, which, generally was I think we received it pretty well. But it's also laid out a lot of things that, I think over my career, what I would just contrast. When I first joined insurance, there are conflicts of interest in, when you're trading things. And just being able to manage those conflicts appropriately, because they do need to be managed, they can't all be eliminated, is important. And so, how we manage those conflicts, how we talk about those conflicts, how we train people on those conflicts, and how we explain the business, which was maybe very intransparent 20 or 30 years ago, versus how we explain it today. It's important. We have clients, and they have absolutely every right to understand how it works, how the market comes together, how we're compensated, and things like that. So I think all that's healthy, because to some degree, once you make that part very efficient and understood, it lets you have a better and a more trusted conversation about your advice. Where else you could stretch some of these principles. If you can't get to the trust, you're going to be in a pretty transactional place, consumer or corporate. So I've been a big fan of a lot of these things, and during my career have had from time to time, you get brought into this stuff because not everything works as smoothly and perfectly as you would like it to when you're around, tens of thousands of colleagues.
Eric, thank you very much for taking the time to chat with us. I'm excited to continue our conversation in the next episode.
I'm looking forward to it.
That was the first part of my discussion with Eric Joost, Global Head of Property and Casualty at Willis Towers Watson. In the next episode, I get the straight talk on diversity in insurance, what innovation might look like, and what it all means for the insurance industry. Thanks for listening.
You've been listening to the Accenture Insurance Influencers podcast with your host, Igrana Yu. To hear all the episodes from Season 1, visit accenture.com/insurance influencers.